And just think about Harley on that standard. So everything I said is true. You know, I saw that guy in bedecked in Harley stuff. You know, 2007, 2008, and the shares were on an absolute tear during 2008, 2007, 2008. And the reason was, at the end of the day, corrupt, and it almost cost the company their livelihood, because what it turned out was going on, and you could know this, is that they had stopped selling to the natural pool of buyers, and they were using their credit corp subsidiary to offer no money down, interest only, loan funded purchase terms for the buyer of a Harley. And so, without credit histories, without anything other than the willingness to sign on the line that you promised to pay someday, people were going off the line with a Harley. Now, what that meant is that they had far greater manufacturing efficiencies than the true market clearing demand would have allowed, because people were buying the bikes that had no financial reason to do so. And the management was kicking the can down the road, because in the low interest rate environment of 2008, they could finance all the borrowing using a credit corp that borrowed overnight through the commercial paper market. However, the obligations were long term. And as a result of borrowing overnight to fund long-term loans that induced people to buy bikes that they couldn't afford, they ended up, when Lehman collapsed, unable to roll over the commercial paper, as did so many companies, whether it's General Electric, which had $100 billion of borrowings overnight. Harley had far less, but Harley basically was threatened with financial disaster. It was only when Warren Buffett and Chris Davis and a consortium of investors went into Harley at that moment and lent them money, not at 0.2% like they were being charged overnight rates, which was flattering all aspects of the business. The business was so massively over-earning, irresponsibly. As stewards of the brand, you would never risk that kind of financial disaster, because what happened then is, obviously, the people who had the bikes couldn't pay interest, so they gave them back to the company. So manufacturing plunged because they were overproducing for the demand fueled by low financing. And so the used market proliferated, and suddenly now you have a real brand problem. You know, who really wants a Harley when it's been turned in and there are hundreds of them, and it loses its allure a bit as being something quite special. Anyways, a business that overstated its demand by easy money, which was allowed because of the very low interest rates, which you could borrow on the credit corp if you chose to, despite the long-term nature of the liability, or the asset rather, which is the loan. They funded it with overnight liabilities, and it all broke down. And Berkshire didn't charge 0.2%; he charged 14%, and those loans were outstanding for at least 5 years. And the brand was badly hurt by this excessive amount of irresponsible conduct. Now, look, I actually alluded to the fact that maybe with Remy there's a little bit of that same kind of irresponsibility relative to the long-term health of the brand by letting it over-earn so badly in China without directing that cash flow back into sort of more normal practices by investing in other regions and trying to grow the platform more stable around the base that was built on a very risky leverage demand. The leverage coming from the fact that the consumer didn't pay for the product, the government officials did, and the banquets did so. Anyways, you're absolutely right to highlight the fact that brands are available in industrial delivered products. It's not just something you eat and drink and smoke. And in the best case, something like Harley is an extraordinarily enduring brand, but it can be managed irresponsibly. And that's what worries me when you deal with businesses that have brands plus capital requirements for the purchaser. So I tend to buy things that are invest in companies whose products don't require lending to purchase.